We're jumping straight into Bitmine Immersion technologies today. Everyone is watching the price action, but the real story is their massive Ethereum treasury accumulation and the push to a $9.9 billion balance sheet.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Subscribe and hit the like button, because today we are unpacking something that's really completely unprecedented in the market right now.
Yeah, the mission for you today is to really understand the mechanics of this massive corporate transformation. We're looking at how a business completely transitions from traditional physical digital asset mining into becoming the absolute #1 Ethereum treasury on the planet. We're going to break down the strategy behind hoarding that much crypto, the unique ways they're putting it to work, and why massive institutional investors are paying such incredibly close attention.
Yeah, I mean, just to set the stage for you, on March 2nd, 2026, we saw this incredible 9% single-day breakout in their stock price.
A huge move.
Right, and it wasn't just, random market noise or some retail trading frenzy. The immediate catalyst was genuinely jaw-dropping. The company acquired staggering 50,928 Ethereum in one single transaction.
One transaction. Yeah.
One transaction. That move alone sent an absolute shockwave of enthusiasm right through the market.
It did. And honestly, if you're looking at Bitmine Immersion technologies through the lens of a traditional company.
Yeah, looking for standard revenue.
Exactly. If you're scanning for standard revenue generation, typical profit and loss statements, or quarterly sales of some software product, you are going to entirely miss the plot.
You have to throw the old models out the window.
Completely. The ultimate scorecard for this company is no longer a standard P&L. It's all about one specific metric: crypto net asset value per share, NAV.
NAV, right.
Think of this entity less like a traditional tech company trying to sell subscriptions and more like a fortress, a heavily fortified digital vault. As of early March 2026, their balance sheet is sitting on a staggering $9.9 billion in total crypto and cash.
$9.9 billion. That number is just, it's hard to wrap your head around.
It's massive.
Just picturing the logistics of that gives me secondhand anxiety. Imagine being the person responsible for the private keys to nearly $10 billion in digital assets.
I wouldn't want that job.
No way. But beyond the sheer scale of it, that specific number officially makes them the #1 Ethereum treasury in the world and the #2 crypto treasury globally.
Correct.
So if they aren't just letting this sit in a cold wallet collecting digital dust, what are they actually doing with a treasury of that unbelievable size?
Well, they employ a very specific, highly disciplined management strategy that they refer to internally as the alchemy of 5%.
The alchemy of 5%. I love that phrasing.
It's catchy.
It sounds almost magical, like turning lead into gold, but I imagine it's actually deeply mechanical.
It is entirely mechanical. It's rooted in decentralized finance. Basically, they're heavily utilizing staking mechanisms. In the Ethereum ecosystem, the network requires participants to stake or lock up their tokens to help secure the blockchain and validate transactions.
Right, proof of stake.
Exactly. And in return for providing that security, the network pays you a yield. Historically, that yield hovers right around that 5% mark. So they are organically compounding their massive Ethereum holdings over time. The asset generates more of the asset entirely passively.
Wait, let's see the mental math on that for a second to really illustrate the scale. 5% of a $9.9 billion treasury, that is roughly $495 million a year.
Almost $500 million.
Let's just call it $500 million annually in pure passive accumulation. If you break that down further, that is well over $1 million of new value being generated every single day.
Every single day.
Just for holding and staking the asset. When you compare that to the profit margins of a traditional mid-cap tech company, it's absolutely staggering.
And the beauty of that compounding is that the yield is paid out in Ethereum itself. So as they accumulate more tokens, their base for that 5% yield grows larger every single day. It's a snowball effect happening on a multi-billion-dollar scale.
But to pull off a strategy of that magnitude, you can't just operate business as usual. I noticed they've made a massive strategic pivot recently.
They really have.
Because historically, they had major exposure to proprietary physical self-mining. They have these established massive energy operations set up in places like Trinidad and over in Texas and Pecos and Silverton.
Right.
But they're intentionally deferring new site build-outs. If mining was their bread and butter, why pump the brakes? Why walk away from building more physical infrastructure?
Because physical mining is incredibly capital intensive, and honestly logistically exhausting.
Yeah.
Think up with the reality of running a massive mining farm in Texas.
The heat alone.
The heat, exactly. You have to constantly buy the latest generation of hardware before your current machines become obsolete. You have to manage massive industrial cooling systems. You're constantly negotiating for megawatts of power with the local energy grid.
It's an infrastructure nightmare.
It really is. And often, companies are forced to take on dangerous amounts of high-interest debt just to finance all of that continuous infrastructure upgrading. By deferring those physical build-outs, they actively avoid taking on that debt-heavy leverage.
So they're basically trading the noise, the heat, and the debt of a physical mining farm for the silent, clean compounding of a staking node.
That is a perfect way to visualize it. Instead of mining, they're focusing entirely on selective equity issuance. They issue shares on the public market to raise clean capital, and they use that capital to directly fund even more Ethereum accumulation.
Wow.
They use the public markets to buy the underlying asset without the operational headaches of digging for it themselves.
That makes total sense. Like, we don't want to deal with the depreciation of hardware and the debt that comes with it. We just want to hold the asset.
Exactly.
But for a strategy that relies so heavily on the public equity markets to raise capital, big money needs to be completely comfortable getting in and out of the stock, which brings us to their institutional moat. How secure is their footing on traditional exchanges?
It's incredibly secure. Their position on the NYSE American Exchange is the linchpin of this entire operation.
Yeah.
We are not talking about some obscure digital token trading on an unregulated offshore exchange here.
Right. This isn't the Wild West.
No, this is a highly liquid, fully regulated public stock. In fact, it has become one of the most widely traded stocks in the U.S. by average daily dollar volume.
And the data points strongly back that up. Let's look at the days to cover ratio, because right now that metric sits right at 1.0. For anyone listening who might be a bit rusty on their market mechanics, what does a 1.0 ratio actually signify? And why does a massive institutional investor care so much about that specific number?
Think of the days to cover ratio, like the exit doors in a crowded movie theater.
Okay.
It measures how many days of average trading volume it would take for every single short seller to close out their positions. At 1.0, those exit doors are incredibly wide.
Meaning everyone can get out fast.
Exactly. It means that if every short seller rushed for the exit at the exact same time, it would only take one single day of normal trading volume to absorb all of that activity.
So nobody gets trampled.
Nobody gets trampled.
Yeah.
There is a very low risk of a chaotic meme stock style short squeeze that traps investors. For a multi-billion-dollar institutional fund, say, a massive pension fund or major asset manager, that kind of liquidity is music to their ears.
Because they need to move big money.
Exactly. It means the pool is deep enough for them to enter and exit $50 million or $100 million positions safely without moving the stock price aggressively against themselves.
It provides a clean, heavily regulated, and highly liquid vehicle for crypto exposure. And we are seeing that third-party validation play out in real time right in front of us. On February 26, Beast Industries CEO Jeff Housenbold came out and publicly endorsed them.
Yeah, that was a major moment.
He explicitly called the company a leader in the Ethereum staking market. When you have a major established industry CEO publicly validating your core strategy like that, what does that signal to the broader market?
It bridges the gap between traditional Silicon Valley tech leadership and the frontier of decentralized finance. It signals that this isn't just some rogue crypto experiment anymore. It's an established, respected, institutional strategy.
It validates the entire model.
Right. When someone with that level of traditional business cachet blesses a massive staking operation, it gives cover for more conservative funds to start taking a serious look at the stock.
That institutional moat sounds incredibly secure, but, no $10 billion fortress is completely invincible. Looking at the flip side here, if I'm playing devil's advocate, we have to look at the structural risks. Because a $9.9 billion digital treasury does not exist in a vacuum. It is anchored to an incredibly volatile sector.
The bear case here is vital for any investor to understand. The most glaring hurdle is pure correlation risk.
Right.
Because their core valuation is entirely tethered to Ethereum and Bitcoin. They have an absolute, inescapable correlation to the broader crypto market. You could have the most disciplined, brilliant management team in the world executing their equity issuance perfectly. But if the crypto market suddenly drops 20% over a weekend, which historically it can and does,
Oh, absolutely.
that immediately guts their net asset value per share.
That is a terrifying reality to stomach. A 20% drop on a $9.9 billion treasury is a paper loss of roughly $2 billion in a matter of days. The stock price will inevitably follow those underlying assets straight down. Is there any structural buffer against that kind of violent market gravity?
This is where that alchemy of 5% does double duty. Those staking yields actually provide a mathematical yield floor.
How so?
Well, even if the fiat price of Ethereum dips heavily, the company is still accumulating more physical tokens every single hour of every single day through staking. So over a longer time horizon, having a larger stack of tokens helps to significantly offset those fiat price swings.
It softens the blow. And it's also worth noting that right now, in early 2026, the macro backdrop for the sector is showing strong signs of stabilizing. We've recently seen Bitcoin find incredibly resilient support above the $65,000 mark.
Yeah, 65K has been a solid floor.
Right. And in the crypto world, Bitcoin is the tide that moves all ships. When Bitcoin holds a massive psychological and structural safety net like 65,000, it tends to insulate the broader ecosystem, including Ethereum, from those catastrophic weekend free falls.
That macro support is a crucial buffer. True. But there is a second major structural risk that we cannot ignore, and that is the regulatory environment and custody scrutiny.
The $9.9 billion regulatory elephant in the room. If you're holding that much crypto, you have to assume every three-letter agency in Washington knows your name.
Unquestionably. When you are a publicly traded entity holding almost $10 billion in digital assets, you are basically walking around with a giant neon target on your back for regulator.
Oh, yeah.
There's massive ongoing scrutiny regarding how those assets are custodied. Regulators want to know exactly where the private keys are held, what the redundancy protocols are, and who internally has access to authorized transfers.
Not to mention the tax implications of generating $500 million a year in staking yields.
The tax treatment of daily staking rewards is incredibly complex and constantly evolving. And beyond that, we have to consider the potential for future SEC or legislative restrictions. There's always the lingering threat that lawmakers could suddenly introduce caps on how much corporate crypto a single public entity is legally allowed to hold on its balance sheet.
That is a very real existential threat. But if I'm looking at how the company's positioning itself, I see a fascinating counter perspective on that regulatory risk. If they have this massive target on their back, how are they mitigating the risk of the SEC coming down hard on them?
Transparency is their primary armor.
Yeah.
Because they operate on a major U.S. exchange, the NYSE American. They're forced by design to use a highly transparent SEC-compliant structure.
They can't hide anything.
Exactly. Unlike a private crypto fund operating offshore, they have to file regular 8Ks, they publish detailed proxy materials, and their asset reserves undergo rigorous audits by recognized accounting firms.
So they're effectively saying to regulators, here are our books, here's exactly what we hold, and here's how we generate our yield. And I would imagine that by shifting their focus away from pure proprietary mining, they are actually actively lowering their regulatory risk profile on the local level too.
That is a massive, often overlooked benefit of the pivot. Physical mining comes with intense environmental scrutiny. You're constantly battling local zoning boards over noise complaints, fighting with state regulators over energy grid strain, and dealing with environmental impact studies.
Is endless red tape.
Endless. But by pivoting to a clean treasury and advisory model, they entirely sidestep that localized red tape. A transparent public holding vehicle is generally going to face far less friction than a complex, opaque, power-hungry private mining operation.
Okay, so we've laid out this massive, unprecedented accumulation strategy. We've marveled at the math of their staking yields, and we've walked through the heavy volatility and regulatory risks that threaten the fortress. What does this mean for you, the listener, right now? Let's talk about the exact triggers and catalysts you need to be monitoring over the next 30 to 90 days. We are sitting in a highly critical window between March and May of 2026. What is the absolute first thing on the radar?
The single biggest upcoming catalyst to watch is their Q1 2026 earnings report, which is expected to drop in late April or early May. Specifically, you want to dive straight into their 10Q filing.
The 10Q filing. Because unlike a glossy, highly produced investor relations presentation, the 10Q is the legally binding truth serum for this company.
A 10Q strips away the marketing spin. That filing will reveal the exact updated net asset value per share, as certified by their auditors. It will show us the real, mathematically proven staking yields they are actually generating and the absolute true holdings data.
So no guessing.
No guessing. If you want to know if the alchemy of 5% is working as flawlessly as intended, Or if the recent Ethereum acquisitions have fully settled into yielding nodes, the Q1 earnings report is the absolute most critical inflection point.
Beyond the company's own internal filings, we also need to keep a close eye on the broader macro environment and network upgrades. For Ethereum specifically, you need to watch for the ongoing follow-ups to the Ethereum Shanghai upgrade. Remind me, how do the technical network upgrades around Shanghai specifically tilt the math in favor of massive treasury holders like Bitmine Immersion technologies?
So the Shanghai upgrade and its subsequent network improvements fundamentally changed the liquidity dynamics of staked Ethereum. It allowed validators to withdraw their staked ETH and rewards.
Which they couldn't do before.
Right. And any ongoing protocol changes that continue to streamline that process, reduce hardware overhead for nodes, or adjust the issuance rate directly impact the efficiency and profitability of massive treasury holders. Improvements in the network's foundational code can literally translate to millions of dollars in optimized yields for a treasury of this size.
And we can't ignore the other half of the crypto equation. On the Bitcoin side, we are right in the thick of the Q2 2026 Bitcoin halving cycle dynamics. Historically, halving years introduce massive supply shocks to the market. But if Bitmine Immersion Technologies is an Ethereum treasury, why should their investors care so much about a Bitcoin halving event?
Because a rising tide lifts all boats, especially in digital assets. Bitcoin dictates the overall market cap and sentiment of the entire crypto space. The supply shock from a Bitcoin halving historically creates major appreciation across the entire ecosystem. If Bitcoin runs, Ethereum almost certainly runs with it.
Which instantly balloons their NAV per share, which ties perfectly into the broader macroeconomic environment. Fed policy, interest rates, and inflation data are the ultimate drivers of risk-on versus risk-off sentiment globally. Tom Lee from Fundstrat Global Advisors just recently called this March a turnaround month. We saw Bitcoin aggressively tap $69,000 recently, which is a massive psychological barrier.
Huge barrier. And when a respected analyst like Tom Lee points to a turnaround and Bitcoin pushes against all-time highs, it signals a massive potential return of institutional risk-on appetite. When traditional money managers feel safe taking risks again, crypto assets and the highly liquid equities tethered to them are historically the first to see massive inflows.
Which brings us to the final and perhaps most culturally significant catalyst to watch: broader institutional adoption. You need to watch the financial headlines for any Fortune 500 corporate treasury announcements regarding crypto.
Every single time a traditional legacy corporation announces they are adding Bitcoin or Ethereum to their corporate balance sheet, it provides massive external validation for Bitmine Immersion Technologies' core strategy. It normalizes the behavior.
Right. If a traditional blue-chip tech company or a major global retailer starts holding crypto instead of just short-term treasuries, suddenly this $9.9 billion crypto vault doesn't look like a wild speculative outlier.
It looks like they were just early to the party.
Exactly. It shifts the entire narrative from speculative gamble to standard corporate treasury management.
It proves the thesis.
Yeah.
And it forces other corporate boards to ask their CFOs why they aren't generating a clean 5% yield on a digital asset.
Okay, we're coming up on time here, so let's get right into the Easy Money Show lowdown wrap-up. We've covered a massive amount of ground today, but here's the absolute core tension you need to take away from this discussion. On one hand, you're looking at an incredibly aggressive, highly liquid $9.9 billion crypto beast. They are ruthlessly utilizing the public equity markets to hoard Ethereum, completely sidestepping the headaches of physical mining, and compounding their massive stack through clean, passive staking yields.
On the other hand, you have to weigh that massive upside against the undeniable, constant, and frankly exhausting threat of extreme digital asset volatility. A 20% swing is a $2 billion fluctuation on their balance sheet. And hovering above all of that is an ever-shifting regulatory landscape that could change the rules of the game at any moment. It is a high-stakes balancing act between pure, relentless asset accumulation and the crushing gravity of the traditional market.
It really is the ultimate financial tightrope. And as we wrap up, I want to leave you with a final provocative thought to mull over as you watch these markets unfold over the coming months. If these staking yields continue to offer a mathematically reliable compounding floor during volatile times, and if public market vehicles like this one can successfully offer clean SEC-regulated exposure without the massive, terrifying headaches of managing private key custody, how long before traditional conservative corporate treasuries are forced to adopt the exact same playbook? Will hoarding digital assets transition from being a niche, crypto-native strategy to an essential, demanded fiduciary duty for every major company on the S&P 500?
That is the multi-billion-dollar question, and it
Right.
might be answered sooner than we think.
Thank you for joining us on this analysis. Remember to keep your eyes closely on the market, watch those upcoming SEC filings in Q1, and subscribe to the Easy Money Show for more market clarity. We will see you next time.